Today, we're tackling a giant. We're cracking open Apple, ticker AAPL.
Right.
This is really for you, whether you're just learning or actively investing, needing that, detailed but clear picture of where Apple stands now and where it might be headed.
It's a really interesting time to do it. Just a few months back, the mood around Apple was, well, pretty negative, wasn't it?
Oh, yeah. Lots of doubt. Skepticism about China, iPhone sales looking sluggish, and that big label, AI laggard.
Exactly. But what we've seen since then is just this sharp, really powerful turnaround in the stock.
Powerful is almost putting it mildly. As we record this, mid-September 2025, Apple's trading right near its 52-week high. Around what, $254?
Yep, hovering right up there.
And here's the number that jumps out.
Yeah.
The last 3 months, Apple returned almost 25%, 24.9% to be exact.
Which is huge when you compare it. The S&P 500 did about 12.2% in that same time frame.
So more than double the market.
That kind of move, that kind of outperformance, it really signals something's changed. An inflection point, you could say. The whole narrative is shifting.
And Wall Street definitely noticed. You've got, what, 29 analysts covering it?
Right, and the consensus is a buy. Some are really bullish, like Wedbush. They're calling for $310.
Okay, so the big question then is, why? What actually sparked this massive rally?
Well, I think it comes down to a couple of key things happening pretty close together. First, you just can't ignore the numbers. Those Q3 earnings they reported back at the end of July.
Right, the financials. How did those look?
They were decisive, a real beat. It showed the core business is still incredibly resilient, you know? Total revenue hit $94.04 billion. That's up 10% year over year.
10% growth for a company that size is pretty impressive.
It is. And diluted EPS, the earnings per share, that was $1.57. So up 12% from the year before. Just solid performance across the board.
And the iPhone, that's still the main engine, right? How did that segment do?
iPhone sales climbed nicely, but what really got analysts excited was the outlook, the forward guidance. Demand for the new iPhone 17 series seems to be tracking 10 to 15% stronger than the iPhone 16 cycle.
Wow, okay, so people are lining up for the new phones.
Seems like it. And that demand spike means they're boosting production expectations by like 20%. It's a significant jump.
So strong earnings, strong iPhone demand. That makes sense. But you mentioned the AI laggard thing earlier. How did they turn that perception around?
That was the other major catalyst. The real strategic pivot, I think, was the unveiling of Apple Intelligence back at WWDC, their developer conference in June.
Right. Apple Intelligence.
Yeah.
Their answer to the AI question.
Exactly. They tackled that laggard criticism head on, but they did it in a very Apple way, framing it around privacy, user control, and crucially, doing a lot of the processing on the device itself.
Okay, on-device AI. That sounds different from what, say, Google or Microsoft are pushing with the cloud.
It is different. And that differentiation, that focus on privacy and on-device power seemed to really resonate. It gave the market renewed confidence in their long-term strategy.
So it wasn't just having AI, it was how they presented it, linking it to their core values.
Precisely. And here's the clever part. They directly linked accessing these new on-device AI features to needing the latest hardware. Specifically, the new M4 chips in the newest devices.
Ah, so if you want the cool new AI stuff.
You need the new iPhone or Mac. Essentially, they engineered a compelling reason for a multi-year hardware upgrade cycle for their massive existing user base.
Okay, that makes sense. That explains why the market reacted so strongly after WWDC, even if the tech was maybe brewing internally before. They needed that clear strategy, that link to hardware sales.
Exactly. It validated the bull case. It wasn't just hype. It was a tangible driver for future revenue. That's what triggered all those positive analyst revisions and helped fuel the rally.
Got it. So the short-term momentum seems pretty clear. Strong numbers plus a convincing AI story. But let's zoom out. The long-term case for Apple always comes back to its foundation, right? That famous economic moat.
Absolutely. A short surge is one thing, but Apple's enduring value comes from how incredibly difficult it is to compete with them. It boils down to that symbiotic business model. Some people call it the flywheel.
Explain that flywheel. How does it work?
Well, think of it as two pillars supporting each other. Pillar one is products. This is dominated by the iPhone, of course. Over half their revenue still comes from it.
The gateway drug, basically.
You could say that. It's the high-margin hardware that gets users into the ecosystem. It plants the seed.
And then pillar two feeds off that.
Exactly. Pillar two is services. This is the real profit engine these days. It's growing way faster than hardware. We're talking over $100 billion a year now.
$100 billion from services. Wow. What's included in that?
App Store commissions, Apple Music, iCloud storage, Apple Care, advertising, Apple TV Plus, all that stuff. They have over 1 billion paid subscriptions across all their services now.
1 billion paid subs. That's incredible.
And the key thing is, services revenue is much more predictable and has significantly higher profit margins than selling hardware. It's like this high-growth annuity built on top of the hardware base.
So products get you in, services keep you paying, and are super profitable.
That's the core loop. Now, what makes that loop so strong, what builds the moat, are really 3 things. First, intangible assets.
Like the brand.
Exactly. The Apple brand is synonymous with premium quality, ease of use, and increasingly privacy. That brand loyalty is intense, and it gives them incredible pricing power.
Which lets them charge more for their products.
Right, and maintain those amazing gross margins. They hit 46.2% in fiscal 2024. That's way above most hardware companies.
Oh, brand power. What's pillar number 2 of the moat?
High switching costs. This is the famous walled garden. Once you're in the Apple ecosystem, it's genuinely difficult and costly to leave.
How so? Like losing your apps?
That's part of it, but it's also losing that seamless integration. Your iPhone talks perfectly to your watch, your Mac, your iPad, your AirPods. Try replicating that smooth experience, mixing different brands. That's tough.
Yeah, it doesn't quite work the same.
And honestly, for a lot of people, especially younger users, the biggest lock-in is social. It's iMessage. Nobody wants to be the green bubble in the group chat.
The green bubble stigma is definitely real. Okay, so high switching costs. What's the third pillar?
Network effects. This is huge. Because Apple has such a massive base of iPhone users, billions of devices out there, it attracts millions of software developers to build apps for the App Store.
More users attract more developers.
And more high-quality apps make the iPhone more valuable and useful, which in turn attracts even more users. It's a virtuous cycle that competitors find incredibly hard to break into at the same scale.
Okay, so intangible brand, high switching costs, and network effects. That really paints a picture of why it's so dominant. Let's connect that to the financials. How does this moat translate into their performance metrics?
Well, the efficiency is just pretty stunning when you compare them. Take return on equity, ROE. That measures how well they use the money shareholders have invested to generate profit.
And Apple's ROE?
It's incredibly high, around 37%. Now compare that to the average for their industry, which is down around 6%.
37 versus 6. That's a massive difference.
It really is. It shows just how effectively they turn capital into profit, far better than their peers. Their EBITDA and gross profit numbers are also just exponentially higher than industry averages, as you'd expect given their scale.
Okay, so they're incredibly profitable, but what about valuation? When you look at ratios like price to book or price to sales, they look really high, don't they? PB's like 45, PS around 7.6.
They are high, absolutely. The 4 PE for 2025 is around 34, which is, in line with other big tech growth names. But yes, PB and PS look stretched compared to traditional metrics.
So is it overvalued then?
Well, this is where the moat comes back in. For most companies, those ratios might scream bubble. But for Apple, the market assigns a premium because of the moat. It's valuing the predictability and the quality of that high-margin services revenue stream.
So the market believes those earnings are safer and more durable because of the switching costs and brand loyalty.
Exactly. It's not just valuing the assets on the books today, it's valuing the locked-in future profits from the ecosystem. And they can sustain that because they generate just an unbelievable amount of cash.
Right, the cash flow. How much are we talking?
In just the first 9 months of their fiscal 2025, so ending June 28th, they generated, wait for it, $81.75 billion in cash just from their operations.
$81 billion in 9 months.
Yeah.
Just rolling in.
It's staggering. And that cash hoard fuels arguably the biggest capital return program on the planet. They don't need to borrow much. They just use their own cash flow.
Meaning dividends and buybacks.
Mostly buybacks recently. In that same 9-month period, they spent over $70 billion buying back their own stock.
$70 billion on buybacks.
Yeah. And when they reduce the number of shares outstanding like that, it automatically boosts the earnings per share for all remaining shareholders. It's a powerful, continuous way they return value.
Okay, so the foundation is strong, the financials are stellar, justified premium maybe.
Yeah.
But investment is about the future. What are the catalysts that could drive growth from here, justifying that near-record stock price?
The number one catalyst, without a doubt, is that AI supercycle we talked about. Apple Intelligence is the key.
Because it forces hardware upgrades.
That's the core bet. To get those privacy-focused on-device AI features, you fundamentally need the new hardware with the M4 chip. So it potentially forces tens, maybe hundreds of millions of existing users to upgrade their iPhones and Macs over the next few years.
Something they kind of needed, right? A reason for people to upgrade when their old phone still works okay.
Exactly. This provides that compelling reason. Plus, we're expecting a major overhaul of Siri sometime in 2026, which should integrate this AI even more deeply into the user experience.
Okay, AI, driving hardware. What else?
Services, services, services. That segment just keeps firing on all cylinders. It grew 13% year over year last quarter, hitting a record $27.4 billion.
And as services becomes a bigger piece of the pie,
It structurally improves Apple's overall profit margins and makes their earnings much more predictable and less cyclical than just relying on hardware hits. That stability is highly valued by investors.
makes sense. Anywhere else they're looking for growth.
Geographically, the big push is India. They've made it a standalone sales region. They're opening flagship stores. They clearly see India as the next massive growth opportunity, potentially like China was for them a decade ago.
And presumably it also helps them diversify manufacturing a bit away from China.
That's definitely part of the strategy, too. Diversification is key. And then longer term, you have things like the Vision Pro.
Ah, yes, the spatial computing headset. Pretty expensive though, right? Around $3,500?
Very expensive. And initial sales estimates are modest, maybe 500,000 units in the first year. But you shouldn't view Vision Pro purely on near-term sales.
How should we view it then?
It's a massive, multi-billion-dollar investment in what Apple believes is the next major computing platform after the smartphone. It's about positioning themselves for the long term, maybe 10 years down the road. It creates optionality for huge future revenue streams, even if it's niche right now.
Okay, so AI cycle, services growth, India, and long-term bets like Vision Pro. Sounds promising.
Yeah.
But no investment is without risk. What are the main things potential investors need to be cautious about?
Yeah, absolutely. The risks are real and significant. First and foremost, you have to talk about the geopolitical situation and their supply chain concentration.
Still heavily reliant on China for manufacturing.
Massively reliant. Over 90% of iPhones are still assembled in China. That leaves them incredibly vulnerable to US-China trade tensions, unexpected tariffs, lockdowns, you name it.
Have tariffs actually impacted them?
Oh, yeah. They absorbed about $800 million in tariff costs last quarter, and they're forecasting another $1.1 billion hit in the current quarter. That's almost $2 billion in costs directly hitting their margins just from tariffs.
Ouch. And competition within China is heating up too, right? With Huawei making a comeback.
Definitely. Huawei is regaining market share in the premium segment in China, which is a critical market for Apple. So geopolitical risk and competitive risk in China are major concerns.
Okay, what's risk number 2?
Regulatory scrutiny. This one directly targets that high-margin services business we love so much.
Antitrust regulators coming after the App Store.
Exactly. You've got the Department of Justice lawsuit in the U.S., and maybe even more immediately impactful, the Digital Markets Act, or DMA, in Europe.
What does the DMA do?
It aims to force gatekeeper platforms like Apple to open up their ecosystems. For Apple, that could mean allowing alternative app stores, allowing developers to use different payment systems, and bypass Apple's commission.
Which could seriously erode the profitability of that $100 billion services segment.
Potentially, yes. If developers can avoid the 15–30% App Store fee, that directly impacts Apple's bottom line. It's a major threat to the current structure.
Okay, China risk, regulatory risk. Anything else?
The third big one is simply execution risk around their AI strategy. Despite the WWDC buzz, let's be honest, they are still perceived as playing catch-up in generative AI compared to Google, Microsoft, and others who are more cloud-focused.
So what if Apple Intelligence isn't actually that intelligent? Or not compelling enough?
Right. If the user experience doesn't feel truly differentiated or genuinely useful, if it doesn't convince people they need that new M4 chip, then that whole force upgrade cycle thesis could weaken.
And maybe the ecosystem lock-in isn't quite as strong if their AI offering falls flat compared to competitors.
It's definitely the highest execution risk, I think. Failure to deliver a compelling AI platform that justifies the hardware push could really undermine the current bullish narrative.
Okay, so summing it up. We have Apple successfully navigating this shift, right? From primarily a hardware company to more of an AI-driven platform company. The profitability is incredibly durable, backed by that moat, validated by strong recent earnings and this new AI narrative.
Right, but it's trading at a premium valuation near its all-time high and faces very real risks from China, regulators, and AI execution.
Yet the analyst consensus remains a buy.
Yeah, that consensus really reflects a strong belief in the long-term strategic direction. It suggests that even at this price, the market might not be fully appreciating the quality, the predictability of that services engine, or the full impact of the AI-driven hardware upgrades that are likely coming.
So here's the final thought we want to leave you with. Apple's stock has surged nearly 25% in just 3 months, right after a period where it really lagged the overall market, the S&P 500. Now, history actually suggests that after periods like that, Apple often sees significant, sustained outperformance over the next 6 to 12 months.
It's an interesting pattern.
So the question for you is this recent massive rebound just the stock catching up to fair value after being undervalued? Or, as many analysts seem to believe, is this the confirmed start of a whole new major cycle of growth and capital appreciation powered by AI in the unstoppable services segment? It really comes down to you weighing that incredibly powerful moat against the demanding valuation multiple.